The burning question about money is, will we have enough to live a fulfilling lifestyle now, in retirement, for the rest of our lives? Do you worry about money? The last 20 years has shown us 7 of the worst 20 down days the stock market has ever had. Perhaps you remember the stock market turbulence in 2001 or 2008. Can you see what happened in 2020 happening again? The problem with the stock market is simple. Are you willing to gamble with your life savings on timing? If you aren't interested in gambling, we would like to introduce you to a strategy that uses age-old principles from the world of finance to create safety, reliability, and the comfort of knowing your income is set for the rest of your life. We are proud to introduce the Flex Method, an advanced high-return strategy that combines the principle of leveraging capital using OPM or other people's money with a core asset that is not only safe, but also creates predictable double-digit returns, tax-free. Leveraging capital plus compounding interest plus tax-free income equals financial freedom. Let's explain how the Flex Method works by showing you how banks make money. Banks are incredibly efficient at leveraging other people's money. The bank model will illustrate how to leverage capital. If you have a bank account, then your deposits are being used by the bank to make loans to other customers. Banks make a substantial profit when they lend your deposits to other borrowers at a higher interest rate than they pay you on the same deposits, usually a substantially higher rate. The difference between what you are paid on deposits and the rates charged to loan out those funds is called profit spread. When a bank uses your funds on deposits to maximize their profit spread, the process is called leveraging capital. Banks are consistent. They act in good faith, and this process of leveraging capital is considered an extremely safe and dependable enterprise that makes a lot of money for the banks. It's mostly done by using other people's money. Step 1. A customer makes a deposit at their bank into checking, savings, money markets, or CDs. The interest rates earned in these accounts are small. Step 2. The bank uses the same money to lend to borrowers for houses, cars, credit cards, personal and business loans. The interest rate on these loans are 3 to 5 times higher than you earn on your deposits. In many cases, even higher than that. The profit spread is created. Banks justify profit spread as a fair business practice since they assume the risk if borrowers do not meet the terms of the loan. It is time to introduce the Flex Method. The Flex Method is not banking, yet it does use the principle of leveraging capital to create a profit spread for you. Unlike banks, the Flex Method does not take on the risk of default or foreclosure. The products used in the Flex Method are safe and predictable. The Flex Method uses a primary core product that is so reliable. It creates a consistent positive return, allowing the account to be leveraged to create double-digit returns. By now, you are probably asking yourself, how are the banking principles of leveraging capital and profit spread going to help me set up tax-free income for life? Let's suppose you have $10,000 to invest in a primary core asset at a 5% rate of return. At the end of the year, your asset should earn $500. A nice return, but not a home run. The Flex Method can more than double your return. Your $10,000 asset is used as collateral to attract OPM, other people's money. In this case, the Flex Method uses your $10,000 asset to arrange for a bank loan to deposit an additional $10,000 on your behalf into your core product. Remember, your core product is paying 5%. The bank loans the $10,000 to your account at a cost of 3.5%. This creates a profit spread in your account on the bank's $10,000 of 1.5%. In fact, the way the core product is structured, the bank will loan the core product $10,000 every year. Now you are leveraging capital. Do this 6 years in a row, and you're getting 5% on your original $10,000 and the profit spread of 1.5% on the $60,000 borrowed from the bank. Don't worry, you are not going $60,000 into debt. Instead, you are simply using the bank's money and leveraging capital to create considerably higher returns on your initial $10,000. Banks do this safely and efficiently every day. So does the Flex method. The difference is, we do it for you. The concept is to add the $60,000 loan to the cash value account of the core product at an average return of 5% annually. The return on the $60,000 at 5% interest is $3,000. The loan on $60,000 at 3.5% interest is $2,100 payable to the bank. This leaves you a 1.5% net profit of $900 without taking any risk. This is in addition to the $500 profit on your initial $10,000 investment, bringing your total net profit to $1,400. That is a 14% rate of return on your initial investment of $10,000. You can return the $60,000 loan to the bank or use the Flex Method income strategy year after year. The terms of the loan and the rate of return from both loans are declared before your core product's annual contribution, so you can plan your strategy with complete assurance of what your overall rate of return will be. Now, let's discuss compounding interest. The Flex Method eliminates risk and provides substantial returns, but it's time that allows compounding interest to do its magic. Warren Buffett refers to compounding interest as the eighth wonder of the world. Let's do some math. What if the Flex Method took your $10,000 and made 14% compounded interest for 5 consecutive years? How much would your initial $10,000 investment be worth then? The answer is almost double, or approximately $19,254. Now that's a great return, without market risk, without market setbacks, and without market crashes. What if your initial outlay was $100,000 earning 14% compound interest for 5 years? Again, the answer is almost double at $192,540. What if it compounds for 10 years at 14%? Your cash value increases to $370,720. What if it compounds for 15 years at 14%? Your cash value would be $713,790. What if it compounds for 20 years at 14%? It would be valued at $1,374,350, all from an initial $100,000 venture. The banking principles of leveraging capital to create your own profit spread, given time for compounding interest, will provide double-digit rates of return. It's time to discuss the core asset product used to execute the leveraging capital to create your own profit spread and tax-free income. IRS Code 7702A allows for the tax treatment of cash value inside life insurance to be borrowed or surrendered tax-free, so long as the policy never lapses. Before we get to the example of how much tax-free income you may receive once turned on for the rest of your life, let's recap. You fund the first year of a life insurance policy with $10,000. Following IRS 7702A guidelines, the policy is written with the smallest death benefit possible and the maximum cash value available. The cash value is recognized by a lender as a Tier 1 asset. Therefore, the Year 2 and beyond premiums can be financed using a bank loan. The Flex Method handles everything. The loan rate is disclosed in advance. Our example was 3.5%. The crediting rate of the life insurance policy example was 5%. The Flex Method has created for you the perfect investment. Your funds are placed in an IRS-approved tax-free vehicle, life insurance, that tells you in advance what rates are earned. The Flex Method uses the cash value as collateral to finance future premiums. You are now using a profit spread to begin leveraging capital, and once we determine the timeline for establishing the need for future income, we customize the perfect plan on capitalizing on compound interest to provide a lifetime of tax-free income. The tax-free income example. Let's assume that you have $400,000 in your Flex Method income strategy account at retirement. Suppose it's still earning a 14% rate of return. What can you expect in annual income? Because IRS Code 7702A shelters the cash value life insurance policy, you could expect a tax-free income of $56,000 annually, with little to no interruption to your original $400,000 in cash value. You are still eligible to receive your Social Security and retain the $400,000 cash value in your life insurance policy. Using the Flex Method, the income from your cash value life insurance policy is tax-free income. The Flex Method combines the best attributes that you would want in your income strategy: safety, high growth, consistent income, tax advantage, and easy access. All other income strategies might have one or two of these features, but no other income strategy has them all, except for the Flex Method. Think of the financial freedom you could have without the risk. Let's take a look at the possibilities of the Flex Method using a comparison. Suppose a 50-year-old male in good health with $200,000 to invest wants to increase his cash savings for retirement until he reaches the age of 66. Let's compare his spendable income after taxes with a traditional cash value life insurance policy, which has an average rate of return of 5%, to an IRA, which has an average rate of return of 10%. We then compare both of these to the Flex Method cash value life insurance policy. Let's also take into consideration that at age 66, the retiree believes he needs to withdraw 20 years of annual income. How much projected annual and monthly income will each strategy provide? The traditional cash value life insurance policy would provide $16,416 a year or $1,368 a month income for 20 years. The IRA would provide $23,676 the first year or $1,973 a month, and then gradually increase each year until at year 20, it would provide $45,937 a year or $3,784 a month, but taxable. The cash value life insurance policy using the Flex Method would provide $80,000 a year or $6,667 a month for 20 years, tax-free. You also do not have to wait until 59 and a half to access your cash. There are no RMDs, required minimal distributions. In fact, follow the IRS 7702A guidelines, and the IRS will never look at this account again. Do you want to just survive financially or thrive? Imagine the things you could do and the places you could go. The team at MIO Retirement are certified specialists in the Flex Method strategy. MIO Retirement is here to help you with your financial journey. From the initial bank funding for leveraging your cash value life insurance policy, through the accumulation period, and until the end of the benefit period. If you are at the beginning, in the middle, at the final stages, or have already activated the spending phase of your retirement, we can help. At MIO Retirement, we understand that everyone is unique. We can help you set up the Flex Method to fit your needs and conditions. Click here to learn more. Contact us today.